and starting now.
Well, good afternoon, everyone. Good morning if you're on the West Coast. My name is Steve Abernathy. I'm the World Floor Covering Association's Chief Financial Officer. I know you're used to seeing Scott Humphrey, our CEO, at this point in the call, but he is a bit under the weather and has asked me to step in and help out this afternoon, and I'll be sort of emceeing this presentation and this webinar. Glad to have you with us. As I said, we've got with us Jeff King. Jeffrey King is our Chief Counsel for the WFCA, and he'll be leading off on the presentation today. We also have Max Perkins. Max Perkins is with Lobbyit. He is our liaison in Washington, D.C. To all of the congressional representation that we have there, and we're glad to have him on board as well today. Just kind of let you know what we've been doing over the last several weeks and months. The legislation has been slow in coming for this second round of assistance, of COVID assistance. It had taken quite a long time for it to get through Congress. There were multiple revisions of it. We didn't know if it was going to get through, quite frankly. It was down to the wire in the Congress. They actually held over to try to make it happen. But we're glad that it is. And so we've been watching it very closely, and with anticipation that we would get something. We didn't know altogether of what was going to happen in the final bill, but hopefully today we can at least answer most of those questions. I will tell you, this is hot off the press. A lot of it is just coming in. Jeff and I and the group were just talking earlier how there's just been some last minute rulings and things that have been added and clarified. And so we're trying to continue to make sure that we bring you the latest, most up-to-date information we can regarding the PPP loans and all the COVID assistance that come through with this legislative bill. So we continue to do that. We hope that you gain something out of today's presentation. And if you have questions, what we'd like for you to do is use the Q&A function down at the bottom of the screen. There's a Q&A and a chat button. We would prefer it if you use the Q&A. And as we get through the sort of the initial presentation part, we'll have a period of Q&A. We will pose those questions to both Jeff and Max, and hopefully they will be able to answer those. If they're not, certainly they'll try to get you an answer for that after the meeting today. So with that, I want to go ahead and let Jeff take it away. And Jeff, if you would, begin your presentation and take us through what's going on.
Thank you, Steve, and welcome to everyone. This has been a long time coming, this law, and I'd be remiss if I didn't explain the amount of effort that was put in by Max and his crew up at Lobbyit Inc. to get many of the provisions that are going to benefit you as we go through this. Increased coverage of PPE costs we'll be talking about, a new second round of loans, a tax break on the loan amounts that are forgiven, tremendous amounts of things that we fought diligently for, and tirelessly for. There were times when I've been on the phone with Max 3-4 times a day through their offices. And this is a difficult lobbying time for the moment. Thank God Max and his crews around in DC, because clearly the restrictions on with COVID and us traveling and visiting Congress are quite significant. And he still managed to pull all of this off with a great deal of ease. So with that, let's start the presentation. And I'd like Max to explain sort of what we've been doing for the last 6 or 7 months. Kind of maybe explain. I'd give you a nice sort of clue in, but it might help us to know the kinds of meetings and what you've been doing and who you've been dealing with.
Sure. Thanks, Jeff. I appreciate the kind words. So as many of you know, the CARES Act was passed back in March of 2020, and the Congress has spent the bulk of the remaining of the year trying to figure out what to do next, what type of relief, what type of stimulus might the economy need in order to make it through the next phases of the pandemic. And of course, we thought way back in May that there would be more relief coming, and it didn't come. And then we thought there'd be more relief coming in August and September, and that was complicated by the election season. And so, you know, as rightly noted at the top, we are very excited about what was finally able to get through Congress and get enacted into law by President Trump just before the New Year. We knew at the outset, as soon as the CARES Act was passed and as soon as the Small Business Administration stood up the PPP program for the first time, we knew that there were going to be many issues with implementation, issues with definitions. As many of you will recall, Jeff and I spent numerous hours pouring through regulatory guidance simply to determine what was an eligible payroll cost that could be included into the calculation for a PPP loan in the first place. That was that was a very difficult issue that we spent many hours working through. So we knew that there were going to be issues after CARES, and they mostly fell in two buckets. One, regulatory issues that the SBA could resolve on their own, and two, there were statutory issues that Congress needed to address in a second relief package. And then the question became, when does that package arrive, and what types of provisions can we get into that package to fix the issues that we're facing? First of all, the first statutory issue was obviously the fact that the pandemic's impacts on the economy were longer lasting than I think originally anticipated by the administration and by Congress in the beginning of last year. So we knew that folks needed a second PPP loan, and was it more advantageous to stand up a second program that mirrored the first program, or were there some needed changes? For instance, means testing. Do we need to look at, who are the legitimate businesses that actually do need a second loan? Who are the large businesses that might be able to find capital elsewhere? And so that was hotly debated. We worked, very closely with bipartisan leadership in both the House and the Senate to figure out the parameters of a second PPP loan program that makes sense for, the majority of small businesses, if not, nearly 100% of all of them. There were other issues, though, going back to the first PPP program, with, chief among them, forgiveness. The forgiveness process that was put forth by the SBA was difficult to understand and not very clear. So we knew that we had to convince Congress to simplify the process for the vast majority of folks. And obviously, when you take a look at loan size and number of participants in the program, we thought that that the loan amount should be closer to $1 million or $2 million for streamlined forgiveness. We had to negotiate with, a very tough Democratic position that was entrenched into ensuring that the government prevent fraud and abuse in the program. And so ultimately, we were able to secure streamlined forgiveness for small loans, $150,000 and under. And as Jeff also mentioned, we were able, in addition to that, include additional eligible expenses into the PPP1 program, so that if you still have some leftover cash in your loan, or if you haven't closed out your forgiveness, you might be able to go back, get some additional money for things like PPE for your employees, maybe some structural changes to the store or to your warehouse that might help prevent spread of COVID-19. The acquisition of business software that might enable you to do things like Zoom meetings or Microsoft Teams meetings are now eligible users of PPP funds. So, helping businesses innovate in the new economy was a specific focus of ours, and ultimately we'll talk through what we were able to do. Jeff.
Yep. So why don't we go to the PowerPoint? We can just do the highlights of this law. I do want to tell you, we are still studying it. The bill is over 5,700 pages. It included a omnibus budget in it. When I first grabbed the bill, I said, let me just look for where the small business PPP loan, all this stuff is. And it's not like in a single section. It's spread throughout the bill. And then when you get to the bill and you start to read what changes did they make, it'll say, well, in section 7B, C small 1, small I, E and F, we changed these 5 words in it. So you have to go back to the original statute. You got to look what was changed in the CARES Act, and then you got to apply these changes to it. So it is a complicated bill. But with that, let's go to the PowerPoint, Louis, and we can go through there. You can jump right into the first slide. So this is what happened. What's in the new legislation for flooring professionals. I'm not going to go through. There is stuff that we probably won't talk about. There's stuff for farms and ranches. There's stuff for hospitals. There is stuff there for unemployment. And while that's important, we can talk about it. We understand it. I've really focused on what's important for those of you who are retailers, contractors, and installers. And first thing is they make revisions to the PPP loan. They created the second round of PPP loans. They've changed the tax benefits tremendously. They've changed the emergency economic injury disaster loan grants. They've dealt with the paid sick and family leave issues that as a result of COVID. And we also dealt with and lobbied a great deal for COVID-19 liability. We need to explain what happened there. Next slide. So this is what it reopens the PPP loans. PPP loans had stopped in July. You couldn't get a loan after that. Well, they've reopened them. So who is it open to? First of all, it's open up to all new lenders. If you've not applied for one, you can apply for one now. Same process. There's some streamlining in it. There's some different calculations in what's payroll costs, which can help you, but that's essentially what it is. You can do it. If you previously returned all of your PPP loan, I know we had some members that realized they weren't suffering the kind of economic loss they thought they would, and therefore they returned their money. You can now apply, particularly as you've now gone through this year, to see what your real needs are. If you return part of it, you can reapply for the amount if that's equal difference between the amount you returned. If you did not accept the full amount of it, you can get and request more. This is particularly true for partnerships. There's a great deal of confusion. And I know some of you guys are LLCs that pay your taxes as partners. So it'll apply to you as well. Many of the people, it was so confusing, they put in their employee costs, but they didn't put their personal partnership costs in, believing they had to apply as a partner separately. Well, all those partnership applications should have been denied. So you never got your money. Well, they're saying, go ahead and reapply now, and we add in that partnership income that you normally would have had that was never in the first loan. And that's a pretty significant addition, particularly for those of you who have a partnership or an LLC that pays like a partnership, which is when you pay basically, you treat it like you're a sole proprietor. You each divvy up your gross income. Next slide. They've also made some pretty significant changes in what are allowable expenses. As Max mentioned, we're going quickly, operational expenses. Computing, you guys have done all sorts of new programming in order to deal with, whether it's buying Zooms, whether it's doing different ways of dealing with your business, more online work, you may have paid for that. Human resources, the payroll changes, all of that you had to make in order to accomplish this, you're allowed now to take as a cost, an allowable expense in the loan. You have the PPPs are covered, and whether that's a new HVAC system in your store, whether it's masks, sanitizers, plexiglass barriers. I know many of you put those in. That is now all part of what is deductible, or is an acceptable expense, I should say. Supplier costs, necessary supplies. They were necessary when they're bought. This applies, or they continue to be necessary. You have to buy them, but you're not. You just need to maintain them to maintain your business, even though you really don't have the business to support it. Or if there's anything that's perishable, or if you've incurred expenses because you could not take delivery for some reason or had other issues. Also, payroll cost guide. This is a big question we had. We all knew that you could do group health insurance, but what about life insurance, disability, vision, and dental? Yes, all of those are now included. And then there's this covered property damage. It's basically damage due to public disturbances incurred since March. So if you've been in a particular area that actually had problems that damaged your store because of protests or anything else, you can actually have that cost covered as well, assuming it's not covered by your insurance. Next paragraph. I should say on that one thing on the thing, what is not clear is whether it would cover only property damages. It's not the particularly clear statute, or whether it could also cover business interruption. And we haven't figured that out. We're trying to get that clarified. So for the forgiveness, they made a bunch of changes. You can include all these new expenses when you go for your forgiveness. You can add them all back in, unless you already got forgiveness. If you've got an application and that been ruled on, and you don't have it, and you're not going to get it all forgiven because your 40% of expenses didn't add up enough, then you may want to withdraw that. There's also a streamlined loan forgiveness application for loans over $150,000. We fought hard for this. We kind of went in saying anything under $2 million, but that covered about 95% of the loans. We went to $1 million, but we ultimately, everybody seemed to agree at 150. That's a small business. That's generally a pretty small amount of people. If you get 150, which is essentially the equivalent of 2.5 months payroll, that's a pretty small business. And they've allowed you to do that. So the SBA has to give a new application out. It's going to be a one-page application. I think both Max and I believe that it's going to be the same as the application they had for loans under 50,000. And it's going to allow you to just, all you're going to have to do is identify what employees were, how many employees you had and how many you retained, the amount of the loan spent on payroll costs, and the total loan amount. I don't think you're going to have to deal with your full-time employee equivalents. Remember, you had to get back up to full speed. You're not probably going to have to deal with the 25% reduction in payroll costs. Any of that's going to be gone. I believe they have not made that clear, but I think it will be. So anything under 150 is going to be a pretty easy process if you spent 60% of the loan on payroll costs. They also changed, before there was a deduction in the amount that could be forgiven as a result of an emergency electronic disaster loan grant. Remember, if you applied for one of these loans, you could also get up to $10,000 immediate grant that was forgiven. Well, when they were doing the forgiveness loans initially, they said, well, when you go for forgiveness, you're going to have to include that $10,000 that has to be included, which meant that $6,000 of that $10,000, if that's what you got, would have had been on payroll. It really messed up the calculation. They now said that's not true. That was given as a grant and it's all gone. It doesn't affect PPP loans at all. So there's no adjustment for that. They've also got a more flexible coverage period. It was, you got 8 or 24 weeks to do your thing. They now said it can be anywhere between 8 and 24 weeks after the loan was originated. They still could stupidly talk about origination as the day you get your loan, which doesn't seem to matter until you're trying to figure out what your loan's supposed to be. There is an issue if you paid less than 60% of payroll. And they gave an example this time that I think kind of shocked Max and I. We had not seen it before. And there's always a possibility they had that hidden somewhere and we didn't see it in the thousands of pages of regulations we've been through, but we've gone through them several times. And what they're saying is, I'm going to give you the example they gave. They said, you have a $100,000 loan, okay? And you pay $54,000 of that loan on payroll costs. Well, that means you didn't make your 60%. And so we all thought $6,000 of that loan is not forgivable. You either have to pay that back or take it as a loan. Actually, it's $10,000. What they said is that how much you reduce the amount of the percentage-wise, the 60%, you also have to reduce the cost by the same amount. So since you only had 54% on loans, you don't get the full, on payroll, you don't get the full 40% on expenses. And that we're going to fight that a little bit. We're going back to Congress. And we're going to go back to the SBA, trying to say this is kind of silly. Makes it a complicated calculation, one, and two, it makes it, it's not, I don't think it's what was intended by the law. So, but be aware of that as you apply for applications. That may affect you now as they have these new regulations out, which came out, I don't know, sometime between midnight and 4 this morning. So we've only gone through them quickly. But next slide, Lewis. To be eligible for a second round, they're going to have a whole new second round. You can't have more than 30 employees. You have to have suffered a 25% or more reduction in gross revenues. You don't have any of your PPP loan left over. You've used it all or will use it all by the time the loan is granted. You get a maximum of $2 million for business. Remember, there was much higher maximums before. But they restricted 2 million. If you own multiple corporations, multiple companies under a single corporate group, so in other words, you have common ownership of, of your real estate company that rents you to the property, to your store, to your warehouse. The warehouse is separately. If you used to be able to get separate loans for all three of them, they're now saying it's up to a max, I think it was $20 million. They say now that max is up to is down to $4 million. These are minor things, some corrections, but they're really trying to go after the smaller businesses that were not seeking those initial 5 to 15, $10 million loans. Next slide, excuse me. When you calculate your payroll costs, they say you can use either 2019 or 2020. Before, as you remember, you used the prior 12 months, which they initially said was just 2019. So whatever payroll costs you had to figure out what your payroll costs are, most people use 2019 when they got their initial loan. Now you have a choice between what you do. Sole proprietors and independent contractors, and it's my belief they'll probably fix that so that it's anybody, can also use the first 12 months before the loan is originated. So in other words, if you apply for the loan, say in February, it would be February to February, as opposed to January to December. The 25% reduction is kind of cool. You have to suffer the 25% reduction. You can compare 2020 to 2019. And if your total gross revenues are have 25% or more loss, then you qualify for this loan. You can also use a single quarter. So if you really lost a ton of money when COVID first hit, whether that's the first quarter or the second quarter of 2020, you can use that, compare it to 2019, and still qualify the loan, even if your gross revenues then went up by 70%, 80% after that. Okay? And when you apply for the new loan, if there's any amount of the first loan not forgiven, you've used all you're going to use on it, and you have to add that into this loan. So if you could get a loan for, say, $100,000 and you had $10,000 left over, you would have to, the loan would be reduced to $90,000 because you already had the first 10. And then you would go through the same process. Next slide. I know this stuff is not uncomplicated, so I apologize. We're rushing through it. I think we've gone through most of this. The forgiveness rules, they're basically the same as the old forgiveness rules. It's 100% forgivable. 60% must be used for payroll. And the allowable costs for the other 40% include all the new costs we talked about, as well as all the old costs, rent, mortgage interest, etc. Next slide. There are some tax benefits to it. First, they made very clear that any PPP loan, whether it's first or second, is not income to you. So you don't have to include it as part of your income. If you use your loan to pay business expenses, you still get to deduct the business expenses, which truly makes this loan a grant, a really important grant. Before, because it was always reduced by your tax. If you had to reduce, it got $100,000, you used it to pay your payroll and business expenses, that was reduced. The value of that was reduced because you couldn't deduct those business expenses from your business. We fought hard for this one. I even think Max thought I was nuts when I first proposed this to him. Say, it's free money. How do you get to use free money and then still claim a deduction for it? And the answer is we got convinced them to do it. And that's an important element. So your entire payroll, all your business expenses are still deductible when you do your 2020 taxes, and you don't have to claim anything for the loan that was forgiven. So that's a pretty big issue. There's also no reduction in the tax base or other attributes of your assets because of loan forgiveness. Sometimes your accountants will tell you this, when you look at your assets, they look at income and value. And if you had a loan forgiveness, it reduces some of that basic asset, the value of your assets. And that's just a hyper-technical, certified accountant stuff, but it's important for you to know that you're going to keep your base for your tax base on all of your assets, and that's really, again, hyper-technical, but very, very important. And again, we fought for that one as well. Next. There's also the employee retention tax credit, and that is, we talked about this at great length. We can go through it on its own. We'll probably give out a new alert to give this more detail. You can go back to the old alert, which explains it in greater detail, but it ended at the end of the year. It's now extended through the middle of next year. It also increases the amount of credit from 50 to 70% of wages. If you're a PPP borrower, you're not allowed to take the credit, however, if you use the PPP loan to retain the employees. So any amount you pay to the employees to keep them, you can't do that. So once that 28 to 24 weeks ran out and you continue to pay them, you start to get some credit. But remember, that is the one double dip they didn't give us. Next. There are other tax issues. There's adjustments to the retirement account. You don't have to take your mandatory draws out. They've extended that. The deferred withholdings for employee share of Social Security. Remember, the president had said you don't have to do this, and then everybody thought it would come to roost on you come next March. Well, that's been extended to December 31, 2021. There's even the 3 martini lunch deduction for the next 2 years, which is commonly referred to, as you know, you only get a portion of business expenses used for food and entertainment, and they've made it 100% deductible now as a pure business expense. Means if you're ever allowed out of your homes and out of your things and you're allowed to socialize, that you can start to deduct that 100% over the next 2 years. And obviously that was meant to help the bars and restaurants in our country. Whether it does or not, I don't know, but it certainly helps me. So, and I hope it'll help you as you propose business and take your clients out to dinner and entertain them. Next. These emergency economic disaster loans have also been changed. You can get them both. There was a little restriction. There was confusion whether you could get, if you got a PPP loan, could you get an EIDL? And the answer is yes, you can, but you can't use them for the same purpose. So you can use an EIDL loan to do capital improvements or to pay for expenses that were not paid with the PPP loan. So they extend this period to do that until next year. There's also some things on low income communities are getting grants. They've actually, on the PPP loan, on both the first and second, they've added smaller banks and local banks into it. So you will have more resources, hopefully, for where you can go to get a new PPP loan, a second round, or if you want to increase it, you have some advantages of going there to get the extra money. Next. Paid leave, sick and family leave. We needed to go over this with you all. They did not change it. They did not extend it. Remember, as of last year, under the Families First Relief Act, you had to give 2 weeks sick leave to anybody who was sick, had symptoms, or was caring for a parent. Caring for a child. And there's lots of rules with that, but that's a basic thing. And 10 weeks if you're caring for a child. And there's a certain amount you had to pay. You had to do that. And to pay for it, you got a tax credit. Well, what they did is they didn't mandate it any longer, but they continued the tax credit. So if you voluntarily pay somebody who have COVID-related reasons, they're sick, they have symptoms of being sick, they're a caretaker that can't come to work because of somebody who does have COVID, or their child doesn't have school and they have to stay home because of COVID. You don't have to give it, but you can, and you get a tax credit for it. So it's a straight out tax credit. So every dollar you spend reduces your tax by that dollar. Next. We fought hard to get something on COVID liability. The Senate, Senator McConnell wanted a blank immunity. Businesses and facilities could never be held liable for if somebody caught COVID. The House wanted something a little less broad and wanted it to be tied to you complying with state CDC and OSHA regulations and guidelines on what to do. The problem was CDC and OSHA never issued them as regulations. They issued them as non-mandatory guidelines. So that had a fight with it, and it didn't go through. That was sort of the one thing thrown. The amounts were reduced. The amount of the $600 of supplemental unemployment was reduced. The amount of the stimulus checks were reduced, and in exchange for that, they didn't have the liability. I still will tell you though, and you can go to our website and you can see a lot of how to minimize your risks. And one of them is simply if you show you did apply to all of these regulations, you did all the proper precautions, they will have a hard time arguing you did something that caused this. It'll be a much more difficult ability to hold you liable for it. Will not totally grant you immunity, but it'll help you a little bit. Next. I wanted to bring this up to you because this came out yesterday. I think it's being published today or tomorrow. There's a new Department of Labor did a new independent contractor rule for a wage and hour. So when you owe wages, are they, and it only applies to wage and hours, overtime, minimum wage, piecework, all of that applies, but they only apply to employees. They don't apply to independent contractors. So they put up this rule. I will tell you, we heavily commented on the rule. We submitted fairly large comments on it. And in the final rule, when they explain it, we are cited multiple times for the proposals we made and did so. They kept the same 5-factor test, and you've seen this test. There's 3 tests for independent contractors. Just to give you a little brief background. One is the control test, which is the IRS test that we all talk about. One is the economic realities test, which is this test, and the other is the ABC test, which has caused all the uproar in California, notwithstanding that 24 other states also have an ABC test. But this is the economic realities test, and it has these 5 things. Did you control the work? Was there an opportunity for profit and loss? And they're going to look at your innovations and investments. Is there skills required to do the work? Do you have a permanent working relationship, or is this more like, an independent contractor? And are they integral unit of your production? What they decided is the first 2 are controlled, basically. Those are the ones you put the most weight on. But so you look at control and whether they had an opportunity for profit and loss based upon their initiative and investments. Those were the 2 big we and that really restricts us down. Skills had some factors, but it helps, but it doesn't mandate it. We know in this industry, we have some retailers and contractors have installers that like to work for them. And if you don't have work from that day, they'll probably go fishing rather than go work for somebody else. And we know that's always been a real big issue. And then the integral portion of production is also added. But none of the factors are completely dispositive. They're going to weigh them. So if you have no control, it's going to weigh favorably, very favorably, in favor of that they're an independent contractor. They also said we're going to look at actual practices, not hypothetically what this could mean. And part of that looking at actual practices is kind of prior practices. We had tried to say, why don't we just look at what's common in the industry? And they felt the law did not allow them to put that in. So they put this actual practice in, which means that we get to argue, wait a minute, this is how it's done in this industry. It's not 100% certain, but the fact that everybody does it this way in the construction industry using subcontractors is an important rule. So we wanted to bring you that up because that literally just came up yesterday. I wanted you aware of that new rule. I want to warn you, this rule doesn't take effect until March. And my suspicion is President Biden will do what every other president has done when they enter office. They stop all recently enacted regulations that have not yet been implemented. President Trump did it, President Obama did it, President Bush did it. They all do, so they can stop these last-minute regulations till they have a chance to review them. So there may be some changes in this. It's going to depend on who's the Secretary of Labor and what he looks at it. We will make strong arguments to keep this test. It's not a radical difference from the old test. It just gives a little more certainty. So that's where we sit in that. Next slide, Lewis, and we can go right to. If you need to get a hold of us, here's our numbers and stuff on there. And I think that this presentation, the slides will be up on the website. So. Steve, I can't hear you. You're muted.
Am I there now, Jeff?
You're there now.
All right, very good. Thank you, Jeff. Lots of information on those slides. We'll have all of this. This whole presentation is being recorded, including the slides, is being recorded and will be posted on the WFCA website shortly after the presentation, probably within a 24-hour period or so. So look for that. If you want to go back and look at it again, review the slides, certainly feel free to do that. I'm going to start. We've got some questions coming in, and I'm going to just pose a few of these as we get them coming in. If you have questions, again, use the Q&A function down at the bottom of the screen to pose your question, and we'll put it before our panelists today, and hopefully they'll be able to answer that and get you an answer for it. So the first question comes in from John. He's asking on the ERTC, do they still have to have 50% loss of revenue to justify it?
We're still going through that, so I don't want to give you an absolute answer on all of it. But
Jeff, that was adjusted in statute, so they reduced it from 50 to 20. You can show a 20% loss.
Yeah, I couldn't remember if it's 20 or 30%, but I know they had adjusted.
So
if you can show a 20% or more loss, you can take advantage of the credit.
Yeah. So it's 20%. 20%.
Mm-hmm.
Okay.
That's right. That's correct.
Very good.
Yeah.
Okay. The next question is, are the tax credits for paid sick leave available to companies who receive a PPP loan?
Yes, provided that you didn't use the PPP loan to pay the leave.
Right. Okay. So as long as you didn't use your PPP funds, you can get the other. If you use your PPP funds, for example, for something else, that is still available to you, those tax credits.
Yeah. So, I mean, the real issue is going to be what 8 to 24 week period do you pick? So if you pick a week where nobody's on leave, you pick, your pay period that you want to cover, and you can get rid of everything in, let's say, 10 weeks and nobody's on leave, that's perfect. And then after that, any sick leave they take can be included. But the issue is whether or not you use those funds to pay for your employees that were on leave due to COVID issues.
Next question is, when is the second round of PPP going to be available to be applied for? That's the big question.
Max and I talked about that about 2 hours ago. The regulations don't say. The regulation on it is it will be effective when it's published in the Federal Register, which will either be tomorrow or Monday. So technically it's effective then, but they have to get the applications out. They don't have any application forms yet. Right. So
yeah, Jeff, my best guess, if history is our guide here, as fast as they were changing the program when it was first stood up, and as fast as they were making changes to the requirements, and I would think that they go live Monday with the new program. Congress actually put a regulatory timeline in statute in the bill that said SBA has got to have these rules for the new program written within 10 days of enactment of the bill. They are within that time frame, and the SBA is ready to meet that. So I think it's just a matter of making sure that the banks have the information that they need, and they have the appropriate amount of time to transition their employees from traditional activities back to PPP activities, and then ensuring that they have the portals and everything ready to go to take those applications. Jeff, as you can remember, back in August, banks started to shut down their PPP processes and their portals because they no longer wanted to participate in the program. So it's going to take a minute to I think, ramp everything back up, but it should be live in short order. And as soon as we have a date certain, we can make sure to blast that out to the members.
What's important also to note is that to apply for the second PPP loan, if it's over $150,000, loan, then you have to show you lost to 25% or more. If it's 150 or less, you don't have to show it when you apply for it. You have to show it by the time you ask for forgiveness. That during the period you applied for it, the prior year you had either a quarter or you had the 2019 compared to 2020, so a 25% or more decrease. So there actually is for 150. It's they made it very easy to apply for it, but you still got to make sure you have the documentation to show you actually lost that 25% either on the average for the year or for a quarter during the year.
Okay. Next question related to that actually is asking for a restatement of the second round qualifications if a business had a single quarter revenue reduction of 25% or more over previous year's quarter, 2020 versus 2019.
Yep. So example, if your second quarter of 2020 was 25% lower than your second quarter of 2019, then you can qualify, assuming you meet the other qualifications, for a second PPP loan. You can't get a second PPP loan unless you've also already had a first PPP loan. And that's not a particular harsh compliment because the PPP loans are now open until March 31st, so you can get a first one still. So, but assuming you already had one loan, you've exhausted those funds, you can show a 25% reduction in a single quarter compared to that same quarter the prior year. You can get a second round PPP loan.
So Jeff, you're saying that you can't apply for this second PPP loan with all of its regulations until you have had the first loan with its regulations, right?
Yeah, but the regulations are actually, the first loan is easier to get in many ways. So it's you don't have to show a 25% reduction. You just have to certify your business was adversely affected. We dealt with a contractor today. His business has been adversely affected because he can't get supplies. He's had to delay everything. So we believe and he did not apply the first time because the business seemed to be fine. He just can't do the business. He can't get the revenue in because he can't get it. So we have him applying for a first loan. And the first loan it's the same amount, 2.5 times your payroll costs. There's a little more flexibility in how you calculate that payroll cost now. And a little more flexibility in how you use it, assuming 60% goes to employees. So the answer is whether you get a first loan or a second loan, if you didn't get a first loan, you don't get a second loan, but you can still get the first loan. That's, I think, why they did it that way.
Yeah, Jeff, and I just want to highlight a wrinkle, and I know you mentioned it during the presentation, but there is a wrinkle for demonstrating that you meet the revenue reduction threshold. SBA recognizes that certain small businesses, most small businesses don't have quarterly revenue information that is readily available or digestible or reportable is even the key. So what they did is if you can prove, there's an allowance in the guidance that just came out this morning. If you can prove as a small business that you're down 25% for the year for 2020 as compared to 2019, they automatically make you eligible for PPP2 loan, because the assumption is that if you're down 25% or more for the year, then you likely would hit the 1 quarter revenue drop. So you don't have to do a quarter by quarter test. You can look at a yearly test and meet the requirement that way.
You can also do it if you're a big business as well. It's not restricted, but they
Right.
They did recognize that small businesses often don't have the accounting systems that allow them to show that quarterly stuff. Certainly some mom and pops would not. And so they said, if you're a small business and you just want to do it year by year, obviously if you had a 25% loss in gross revenues in 2020 compared to 2019, that meant you had to have at least 1 quarter, if not multiple quarters, that you were down at least 25%. Or all quarters could have been down 20%, but they don't make you pull out data that you don't normally keep. They allow you to do it on a yearly basis.
Yeah, we had a similar question to that. Someone was asking, could you use bank statements to show, because they don't do quarterly financials, monthly or quarterly financials. Would a bank statement suffice as proof that your deposits were down 25%, for example?
They said you can use accounting records, bank statements are allowed to be used. Obviously, you use those to show your loss for the quarter. Just be aware that you are subject to audit and make sure that they're accurate. But again, you're looking at most of you are looking at the first or second quarter and possibly the third quarter of this year. And so those records are probably been adjusted and pretty accurate. And so long as you have that, yeah. And if there's a mistake in it, to be honest with you, they're simply going to adjust and tell you don't get you got to pay back a small portion of it, or it's going to, it wasn't properly given. So you make a mistake for $5,000, you're just going to, once they do their audit, they can just make you pay the $5,000 back. And there may be an interest, but the interest is 1%.
Yeah. So a question has come up in relation of the first PPP loan to the second PPP loan. Are you able to apply for the second PPP loan if you have not yet applied for forgiveness and reconcile the first loan?
Yes, I know that. The answer is that was a lot of confusion to us as well. Max has probably looked at this as well, and I'll let him answer separately. But my understanding is, yes, you can. You just have to have used the money.
That's my understanding as well, Jeff.
Yep. The only requirement is use, but it doesn't mean it's been forgiven yet. But if you have an amount that you have gotten forgiven and there's an amount that's not forgiven, you can keep that amount in, and it's just, so it'll become part of your second PPP loan. So let's say you had a $100,000 loan, you could only get forgiven of 90. You can take, and you get a second PPP loan worth $100,000 again. You take you'll only get 90 in cash, but you get to keep that first 10. You don't have to pay it back or take it as a loan. So there is a way of roping them together.
Yeah, Jeff, I would certainly recommend waiting until the bank provides you with the streamlined, the one-page forgiveness form if you're a loan that's 150K or under. It doesn't make much sense to talk to your bank until that form is available. It'll just make your life so much more easier to use the streamlined forgiveness than to go about it right now.
And I would think there are very few of you that have not had some adverse impact, whether it's additional costs, whether for PPP or business-related expenses, online selling has increased, and therefore you had to do programming. You had delays in supplies that have adversely affected your payment schedule. So there's probably a pretty good argument that if you've yet to take a PPP loan, you can make a fair argument that I have been adversely affected by the COVID-19 pandemic. The second one is a more absolute dollar amount, but the first one is just that I've been adversely affected by it. So if you have not applied for one or not taken the full amount, you may want to consider taking more or applying for it now. You have until the end of March or when the money runs out. So just beware. We don't want the money to run out on you.
Very good. So another question is, when should you apply for forgiveness if you're going to apply for a second round of PPP loan?
The answer is many lenders, and I'm sure the people on this phone call can verify this, many lenders won't take applications for forgiveness.
Right.
They were recognizing that they were going to have these changes. And if those of you who have watched this process, the first application form was like 13 pages long. I had one client say, I think I'm going to spend more in accounting fees figuring out the form than I am what I got on the loan. Yeah. So that has been a big issue for everyone. And so so the bank started to sit there and the lender started to say, wait, why don't we see what's going to happen? So the first one was the under $50,000 loan had simplified, but even then many didn't take it because they wanted to see if there was going to be a bigger number. We had all guessed it was going to be 150. We didn't think we could get more than that, but we all thought anything 150 or low would have this expedited forgiveness system. One page, simple. You write down the amount of the loan, you write down how many employees you had, how many employees you still have or retained. You write down how much was paid on payroll taxes and how much of the loan was given. And boom, you're done. You don't have to verify your full-time employee equivalents. You don't have to verify salaries to go down by more than 25 or wages by 25%. None of that that's in the under 50. We think it's going to be the same for the 150. It makes the most sense to get that out right away. So once that final 150 is done, I think you'll start to see the banks accepting them. If your bank is already accepting them, you might as well apply now if you can get 100% done.
Get it out of the way, get it.
There's not a reason to wait. You have 10 months from the end of your loan period.
Right. Will the second loan have the same choices of 8 weeks to 24 weeks on the payroll side?
Yes, and any time in between. So for example, we had some people say, you know, I can retain my people here and keep my full-time equivalents, which was required, but I'm not going to be able to do it for more. I'm not going to spend the whole loan in 8 weeks, but I'm going to have to start firing employees if I don't get more money or business don't improve after 12 weeks, but I'll have spent all the money. And so we said, then this allows you, it didn't allow you to use 8 or 24, it allows you to use anything between 8 and 24. So that's a much better deal. Many of the terms apply. It's a 5-year loan. It's 1% interest. It's called 100 points, those of you who understand finance better than me. And that's where it is. So it's basically the same loan. It's just qualifications a little different, and but the amounts is kind of similar.
Yeah. Another question back on the ERTC. They're asking is on the ERTC, 20% less revenue change. Is that a per quarter also? Per quarter decline?
I'll have to go back and double check that, because that was in the original CARES Act, and I'm trying to let's see.
If you have it in front of you, fine. Otherwise, I go back, because you got to go back.
It's a year-over-year decline of 20% or more.
Year-over-year?
Yeah.
Not quarter-over-quarter. In other words, you can't use a
year-over-year decline.
The year-over-year decline.
That's right.
I think that's what they're asking. Another question around the 3 martini meal. When does it go in effect, and can Biden truly stop it?
It is in effect now.
It's enacted now.
No,
Biden can't stop it without legislation. And you should be aware, I mean, this legislation, please understand, for example, the fact that you could deduct expenses that were technically paid for with PPP loan money was exactly opposite of what the IRS had ruled. The IRS had ruled, if this is free money, then you can't claim tax deduction for expenses used with free money. And there's a great deal of logic to that argument. But we also argued back, but it makes the value of the loan much less. It's not as valuable to us any longer. It's reduced by that tax implication, and in places where you're paying, individualized taxes, or you're paying and everything else, that can be a pretty significant hit on you all. And so they are willing to do that, but this law can't be changed. It's effective. I think it's effective January 1st, if I recall correctly, and it's effective for 2 years. And unless there's legislative change, that's it.
Yep, calendar year is 21 and 22. So you get 100% deduction on meal expenses. And I will say Congress, in the writing of the provision, also acknowledged the circumstances that we're living under. So they included carryout and delivery meals within the meal deduction. So for those of you who are going to work these days and rely on Uber Eats or other delivery services for lunch or for dinner or those types of events, those will you can include those costs, the cost of delivery and carry out meals into your deduction. So
very interesting. Here's another interesting question for the PPP2. Can you use any consecutive 3-month period on the 25% reduction, or does it have to be a formal quarter ending?
I believe, unless you're seasonal, it's by quarter or annual. Seasonal employees get a little change in that.
Okay.
And there are a little more, we haven't gone through that because I don't think our members are seasonal. There are a possibility that it could affect them. We're still going through the rules on seasonal employee businesses and what is considered a seasonal employee, because there may be surges in some of your work, particularly at our installer groups, where they may have a lot of work at one part of the year, but for 6 months and not for the other 6 months. And we have to look at whether there's some benefit there for them. But those are a little different calculations. And in all honesty, we went through the regulations this morning when we got up and as we read them, and I noted them, but I didn't study them well enough to know exactly how that is. But otherwise, no, it has to be a quarter or a year for most businesses.
Yeah. Okay. Very good.
That's correct.
Jeff, Max, is there any sort of gotchas or quirks in the forgiveness language? I know that's always a everybody wants to know, am I going to get the forgiveness? So is there any kind of oddities or quirks there that we need to be careful with?
The biggest quirk we saw, which again, we did not see in the early regulations that we can find, at least at this point, again, was when we read it, is that you have to spend 60% of the loan on payroll and 40% of the forgivable amount on the other expenses. Well, I didn't think that was in the law, but that is how SBA is interpreted. Well, if the forgivable amount is smaller because you didn't pay the full 60% on payroll, then the amount, the 40% is smaller too. So the example they gave is somebody took, this is right in their in the regs, their interim final regs, says somebody took a $100,000 PPP loan. They paid $56,000 in payroll. So that's a $6,000 that's just not forgivable. But when you apply because of that reduction in the amount that is forgivable, because you didn't pay the full 6% on payroll, you're also going to reduce the 40%. The amount of the loan that's forgivable is reduced. So you, instead of have to give about $6,000, you had to give back $10,000.
Yeah.
And that's a weird quirk. I'm not sure that's in the law. Max and I talked again about it earlier today. And we may go either back to the Hill, or we may go to the agency and see where we can get that fixed a little bit, because it makes this calculation so darn complicated.
Yeah, that really makes it complicated. It's sort of a moving target when you've got that.
Yeah, I mean, if you missed for 60% by $2,000, you knew you weren't going to get $2,000 of it forgiven. Well, that $2,000 now is $4,000 or $3,000.
Exactly.
You know, so it's just a and that was a quirk we were very surprised by.
Okay, very good.
Yeah, Jeff, the other thing I would add is, due to a statutory provision, I would expect that banks would include a voluntary section on forgiveness forms with regard to demographic information. It's one of the things that Democrats wanted to make sure that the government was collecting, but I want to stress the demographic section of those loans is voluntary. You do not have to fill that out if you do not want to. So just be aware that is something that will likely pop up in these forgiveness documents and these applications. You do not have to fill that in if you do not want to.
Yeah. That actually was in the original documentation as well. They had it in there, but it didn't look so voluntary when you read it. So those of you who have done loan forgiveness, you'll see they already had some of that information requested to be provided in there, and it was voluntary at that point. That would probably not be different. Whether they're going to, I assume that it'll add a second page to the one-page forgiveness, though. Because you couldn't fit all that information on a single page, or you couldn't read it without magnifying glasses.
Okay. We got two more questions. We're almost to the top of the hour and the end of our allotted time, so to speak, on this call. But if you've got other questions, certainly put them out there. We'll try to get to them. One question is on the meal deductions, the lunch meal deductions, again, back to that question. Are they for the client meal as well as for company meals for employees and owners through 21-22? And does that cover traditional T&E where applicable, or just the meals expense of T&E?
It's just the meal expenses. I read it. Which makes a big point for you if you have something like let's say you take your clients out on a fishing
golf
trip.
Fish.
Right?
Yeah.
You take them on golf. Make sure you get a separate bill for the food and beverages than you get for the golf or the charter of the boat, because the charter of the boat or the golf fees are not deductible, but the meals are. Exactly. And we have given advice on that before. That's always been true. It's just now it's now 100% instead of 50%. So we've always told people, make sure you don't get a flat bill. You want all that broken out so you can take advantage of it.
And can you do it just for employees, or do you have to have a client in the meal?
I'd have to go back and look at the IRS regulation. I don't recall. Some of those expenses. I mean, there are it allows business expenses for travel. So you can take your, those are straight out expenses though. So when you eat, when you're out away from home, I don't recall it being for employees.
Okay.
Unless there's a function for it. I don't know. And I have to go back. Scott,
Okay,
I assume actually.
clarify that one. Yeah, maybe we can clarify that.
You may know that better than I.
Well, it generally speaking, you want, you're safest if you have a client with you. Let me just say it that way. You're safest if you have a client. I don't know in regards to this particular law how they're going to rule on it, but
it doesn't look like it changed anything from the old rule other than it allowed 100% deduction.
That's right, Jeff.
Yeah.
So
if you're traveling,
and I just don't, and my recollection is you needed a client, at least we've always advised to have a client. Whether there are exceptions to that, and there probably is a way to get an exception to that. But it's not going to be where you just provide lunch every day for somebody, for employees. That doesn't work.
So last question we have at the moment is, my 25% loss will not show up on my books until February or March of 21. Can I use year-to-year comparison using my first 2 or 3 months of 21?
Well, if you have a 25% reduction for the first 3 months, I would hope a quarter would fit in there. You can just use the 1 quarter. They recognize
you won't have a full quarter for 21 if it's, she's, only getting February or March statements. You won't have a 21 quarter.
My concern is that you lost your money in February, March, and May, and that doesn't create a, February, March, April, and March, and it doesn't create the right quarter for you because you're pulling 2 months from one quarter and 1 from the other, and that may be the issue. And it may be such a big deduction allow it. My recollection is the regulations. I got to go back through this, Max. You may have better, but they allowed you to use your tax forms even if they weren't filed or truly completed. So fill out the tax form and use it that way. So if you can put that in, even though you have, pardon?
Yeah, I would also say that if your loan amount, your loan amount is going to be under $150,000, it's really not an issue. You don't have to prove or show documentation that you're down 25% or more until you go to file for forgiveness. So, if you're a smaller loan, I would say, be aggressive, try and get your lender to organize an application for you and get moving as quickly as possible. Worry about it when you go to apply for forgiveness. If you're over $150,000 in loan, you obviously have to have your ducks in a row up in advance. There should be money left in the program by the time we get to February or March. You should be okay there. But as Jeff mentioned, maybe look at a quarter, maybe look back a little bit into your specific quarter revenue loss and see if you can meet the requirement that way.
If there's any way you can do an estimate on it, and a fairly accurate estimate on what you have for that quarter, for your last quarter, I would do that, particularly if it shows a annual 25% loss for you. Because it says that even if not filed, it talked about the 2020 tax forms is a good use. Even if not filed was a word I recollect in the regulation they used, which means that you're doing a draft of it. You haven't finished it all. So that would be my recommendation. Or if your accountants are capable of giving you a good estimate, if you have accountants, do that.
All right, well, that's brings us to the end of the questions that we have. We might have got just one more just came through. Nope, a couple more, actually one more. How are the states going to handle the tax status of the forgiven PPP money?
Max, have you heard anything? Because I have not. I assume it's forgivable. It's federal grant money. And
yeah, I haven't heard much on this issue. States tend to follow the federal,
they generally do.
Federal government on stuff like this too. And I would assume that a lot of legislatures that are in now will have to pass some sort of law or regulation at the state level to ensure that you guys aren't taxed on your PPP loan proceeds. So I would assume all 50 states follow suit.
Yeah, and I think the states will probably, if they don't do a law, they'll do a regulation on it. They'll let their revenue bureau do their regulation on it. You'll probably end up identifying it on your tax returns, and you'll identify how much was forgiven. I suspect that'll happen. I think a lot of people are going to ask for that information. But after that, it's going to just be a matter of probably the states. I think there'd be an uproar if the states tried to tax it.
I would probably agree. I think that'd be a big uproar. There are exceptions, obviously, on each state around depreciation and things like that. You know, accelerated depreciation, for example, on, you know, the special depreciation options you have to exclude on the state returns in some states.
And the tax base can be affected on the state basis where it's not on the feds. But since the feds have addressed a lot of those issues, it's not taxable income. You can take the deductions even if you use this money for it. It doesn't affect your tax base, etc. And I did want to mention one thing. I don't know if I said this. If you had a PPP loan and that put you over, made you have less than a 25% loss, don't worry about it. You don't count the PPP loan in calculating your 25% loss. I just want to make sure.
You don't count that as income.
But
right?
The fact that the feds have addressed all these directly, it would probably behoove a state not to fiddle with that.
Yeah. Really, what you have is a loan. So the loan itself is not an income item. These are all PPP as a loan. The only thing that could theoretically be an income item is the forgiveness of that loan. And you know, they're explicitly saying at the federal level, these are not to be considered as income when the loan is forgiven.
Well, when we first looked at this issue and the deductibility of it, we were trying to figure out, could we not ask for forgiveness until 2021 and therefore take the expenses as, since the loan wasn't forgiven yet, but take the expenses as a deduction. The IRS eventually ruled saying, no, you can't do that either. But, you know, we're trying to find clever ways around. The beauty of this is now they've made it quite clear. You get the deduction and you don't take the income. So it's a really good solution for our members on this. So
very good. All right, well, that's all the questions we have for today. Any final comments from Max, you or Jeff? Appreciate all the hard work that you guys have done on this. This is a tremendous amount of information.
I just like to thank
we, as I said, will be posting this. Go ahead.
Yeah, I was going to say, as before, as we did, last year, Jeff and I are happy to field questions from individual members. Feel free to reach out to us. Contact information is in the presentation. We'd be happy to help where we can.
And just so you know, there's also a, you can go directly to WSCA and they actually use Podium, and you can send questions to Podium and they all get answered. They get forwarded and answered to Max and I, or you can go directly. Our emails are on the presentation. But I'd also, in final, just like to thank Max and his group for the immense amount of work they've done to help us out.
Absolutely.
The amount of money they've probably saved all of our members collectively is just enormous, with the taxes, with the extra loans, with the forgiveness aspects, the expansion of it, the ability to continue to take business deductions, even if you paid for those deductions. PPP loans are more than just invaluable extras. So I want to thank him a great deal.
Absolutely. Does an awesome job for us and represents our membership very, very well in Washington, D.C., and it's much needed. And again, thanks everyone for coming and being a part of this presentation. Thank you for all your questions. It's really been good. There's been a lot of interaction, and we're just glad you're joining us today. We will be posting this, as I said. Jeff did mention, I was going to mention it. Go to the website, wfca.org. You can pose your questions there. We will route it to the appropriate person that can answer those questions if you do that. So feel free to take advantage of that capability. Also look for additional presentations. This thing is still fluid. There will be rulings that come. There will be more interpretation, more reading, as this thing is a huge, huge, huge package. And so look for additional seminars and web presentations. We intend to do that as the need warrants. And thank you for coming in your time this afternoon. And
can I ask one?
Yeah.
One of the things Max and I had thought to do at Surfaces this year, but obviously it's not happening, is we thought we might put together a small presentation on what to expect in Washington after the election. If you folks are interested, let us know, because it's a lot of work to put that together, and we're more than willing to do it for our members. You got to pay for it if we do it at Surfaces, but it's something we're more than willing to do for our members. to give you sort of a lowdown of where we think this is all going to go and what to anticipate and what to worry about and what to take joy in. So if you folks are interested in it, just send a little note to WFC if you'd like to hear some of that. So I don't mean to add to our burden, but I'm relying on Max to get me up to speed anyway, so it's easy for me.
All right. Well, thanks everyone. Have a great afternoon. Appreciate you being here.
Thank you. Thanks, Steve. Thanks, Max.
Thank you.